And welcome, everybody. My name is Robin Klaterbaugh, and I am the Senior Director of Marketing for interRel. I am joined by my colleague, Brianna Morris, who will help facilitate the Q&A sessions at the end of each presentation. So I want to thank you for joining us today to hear about how Nationwide and Western Alliance Bank made the most of their Oracle Enterprise Performance Management solutions. So our first session of the day, after overcoming some technical difficulty, will be presented by our friends from Western Alliance Bank. They will be talking about how they have made the most of their Oracle EPM suite. Then we will be followed by a presentation from Nationwide, and their session is entitled Head in the Clouds, Nationwide's Journey to Oracle Enterprise Planning and Budgeting Cloud. We'll end the conference with an interactive leaders roundtable discussion with all of our presenters. So now let me welcome the Western Alliance Bank team and have them introduce themselves.
Thank you, Robin. Good morning, everyone. My name is Valentino Hafalia. I'm Financial Planning Analysis Manager at Western Alliance Bank, and I will be joined today by my colleague, Johnson Lee. Here's kind of a short bio on both of us. Essentially, we're FP&A geeks, spreadsheet men, basically. But we have dabbled a lot in technology. And in fact, we're both EPM administrators. So we understand the technological aspects of the platform that we're using, as well as the business aspects for the businesses that we support. And today, we're going to talk about how Western Alliance uses EPM. There are basically four kind of topics that I'd like to sort of cover today. The first one is budgeting and forecasting. Of course, we all use EPM for budgeting and forecasting, but hopefully we'll give you a little bit of insight into the unique way we're using it here at Western Alliance Bank. Secondly, we use the platform for our management reporting. And the management reporting also extends to SEC reporting, our 10Qs and our 10Ks. And we have a little bit of a success story we'd like to share with you. Third, EPM has as a backbone Essbase, Oracle Essbase. Very, very, very powerful tool. And we use it not only to help our particular division, FP&A, but also other areas of the bank. And hopefully, one of the overarching themes is that we'd like you to begin to think of the EPM tool in a holistic way. How does it help the firm in total? And then finally, we're going to cover M&A modeling, which I think we have a pretty unique point of view. I've never heard of another company that's using EPM this way. All right. So with budgeting and forecasting, we all do it. It's part of our job. But we'd like to sort of rethink the framework. And when we say framework, we're really talking about kind of the philosophy and the processes. The philosophy are, look, there are several approaches, several methodologies to budgeting and forecasting. And you've probably heard of top-down, bottoms-up, activity-based costing, zero-based budgeting, ZBB, that seems to be a hot topic. Incremental, historical, I think there are about 30 of them that are out there. And there are also several techniques that you could use to help you in your budgeting and forecasting. There's kind of distributed, where the rest of the business has a hand in putting together the budget. Consolidated, where FP&A actually drives the entire process. You could use run rate averages. You could use trending, rate times volume. And then the really sexy topic, and we'll get into this more later with Johnson, using predictive technology. And here we're actually talking about the power of statistical models. Now, the point is, look, all the methodologies, all the techniques, they're all good. They all have pros and they all have some downsides. But here's the key thing. Why limit yourself to just one? Why not mix and match? And the power of this budgeting forecasting tool allows you to do that. What do I mean by that? Well, first, we're advocating that you review your financial statements. So instead of approaching the budgeting forecasting season, if you will, and actually it never stops, look at your financial statements line by line. So each line should be sort of evaluated and examined. And don't forget the non-financial statement line items. Often they're called statistical, things like number of transactions, FTE, et cetera. And the methodology and the processes that you associate with each line item should be guided by some matrix of risk and cost benefit. So for every line item, ask yourself, what is the exposure to the firm? And what resources are needed to calculate that line item? Once you understand where the pain points are, you can then plan accordingly. Here's an example. And this is kind of a four-box look. You may be familiar with this, where on the left-hand side, we talk about resource commitment. It's either low or high. And on the bottom, we talk about exposure to the firm. Is it low or high? And here we've taken a sample of financial statement line items that we look at, and we've sort of placed them, in this, and we're trying to evaluate what we do. So if you take a look at the upper left quadrant, where the resources are high, but the exposure is low, we put in things like other fees and occupancy. For us, actually for many businesses, occupancy is typically doesn't move that much year to year or month to month, but it tends to be very complicated, especially if you have multiple locations, if you own space, if you lease space, when does the lease term expire, that sort of thing. But again, at least for us, and probably for most businesses, it doesn't move the needle that much. There isn't that much exposure. Of course, that is going to be different if you're in a period of expansion where you're increasing your office space, or you're in a period of contraction where you're looking to close down office space. But for the most part, it doesn't change for us. So we would put that in the upper left quadrant. Other assets is in the lower left quadrant for us. And I guess it should probably be that way for most businesses, because it's usually not a main driver of who you are as an entity. Moving over to the right, where the exposure is high, and where the resource commitment is high, we would put things like loan volumes and interest revenue. Interest revenue for a bank, very, very difficult to calculate. Multiple components. You might have multiple scenarios. Interest rate shocks to the interest rate curve that you're using. Heavy in terms of resource commitment. If you notice in the upper right quadrant, I put a picture of number one from Monsters, Inc., my kid's favorite film, mine too, I suppose. Number one was always, her favorite saying was, always watching, Wazowski, always watching. So that's those financial statement line items where the exposure is high and the resources is high, are where you want to put your eyes, the most number of eyes in that upper right quadrant. And then going down to the lower right quadrant where the exposure is high, but the resource commitment might be low, we put things like FTE and asset metrics, and we'll talk about that later. But FTE may not be that hard to calculate depending upon your business. But as we know, FTE is going to be anywhere from 60 to 80% of your direct expenses, right? Because FTE drives compensation. Well, how does EPM help sort through all this stuff? So once you've gone through your evaluation process and you've identified things, things that have a large number, that use a large number of resources, and here we're talking about both people and technology to sort of calculate, but low exposure should utilize cost-efficient methods. We would suggest, perhaps a consolidated approach. FP&A uses that, or drives the budget and forecast using some sort of trending run rate average, or even predictive technology. Items that probably are not heavy on resources, but have high exposure should combine cost-efficient methods with increased oversight. And here we would suggest perhaps a distributed approach, but a distributed approach using predictive technology. So in other words, have your line of business leaders take a look at these items, but give them a range of possible answers. And the predictive technology is kind of what we're talking about, and that helps you. Now on predictive technology, using our grid on the right, we would really just suggest to use it when exposure is sort of low, right? And either resource commitment is low or high, but where the exposure is low, predictive technology works, right? It just saves you time. Where the resource requirements are sort of high, and the exposure is high, we would recommend that you just not use predictive technology. And I'm sort of couching that and saying, just not for now. Why? And remember that box, that upper quadrant, upper right quadrant, are your mission critical items. And the hesitancy we have kind of stems from my own experience. Back in the 90s, I worked for a company called Murex. They were a software vendor, and they specialized in pricing derivative products, interest rate swaps, options, equity options, FX, all that sort of stuff. And the calculations are really, really, really hard. The math is very involved. We had a lot of quant scientists who worked for us. But this was also a time when long-term capital management went under. They were a hedge fund, they went under. And long-term capital management, and it struck us, we were in the business, it struck us as significant because one of the principal partners to long-term capital management was Myron Scholes. Now that name may be familiar to you because Myron Scholes is one half of the Black-Scholes option pricing model. So the big takeaway I took from that whole fiasco was that, look, if the Nobel Prize winner in economics can't get this right, maybe you should be fairly cautious about using this technology. So I do recommend it. We do recommend it. But for mission critical items, you have to sort of think. The neat thing about using predictive technology that's inherent in EPM, either strategic modeling or predictive planning, is that the technology will translate out into speed. These things are, both the strategic modeling and the predictive planning, it's easy to use. It utilizes several modeling techniques, and it actually chooses the best fit for you. Uses time series, ARIMA. Monte Carlo is probably going to be available later on. It gives you graphical and statistical output, so you can track these things and present them to management. And, a big plus, you could upload directly into your budgeting or forecasting scenarios. Now, here's a hint. Because of the speed, you can use your statistical models as sort of a first pass calculation. And then, whether you decide to use it or modify it in some way, it's up to you, but you gain a lot from that speed. The big, however, and I mentioned this on the last slide, and this should probably be in red, is that, slick technology, no matter how good it looks, should never replace, reasonableness and sound judgment. And always, always, always avoid the pitfall of relying on a black box answer, okay? Always reserve the right to make changes as appropriate. Remember Myron Scholes. But take advantage of the calculation speed. And this is what we found. A forecast, which might be 70 to 80% acceptable, but generated within seconds, is extremely valuable. This is where using predictive planning will help you. Whether or not you use the predictive planning to to actually populate your budget or forecast is another decision point, but at least you've got an answer that might be 70, 80% workable without doing that much work. And with that, I'll turn it over to Johnson Lee, who actually is the architect of our predictive planning models. So Johnson.
Hi, everyone. Thanks, Val. Hi, everyone. My name is Johnson Lee. I'm one of the senior analysts in the FP&A group with Western Alliance. Since I was with the bank about 3 years ago, we've explored other tools within predictive planning that that Oracle EPM has provided, and just exploring that, we can see that we can leverage these tools with some of the data sets that we have in our planning and budgeting cube. And you'll see that the tool has like a series of different methodologies that it'll use, and instead of just calculating manually, again, like Val mentioned, the predictive planning offers the highest confidence rate of some of these options that are available. So if you wanted to forecast what your loans or deposit balance growth would be, or another metrics that we used to test out was the asset qualities. It's a little bit hard to predict on what that would be, but since we have like 4 or 5 years of historical data on a monthly basis, we were able to basically run this predictive planning across and then write the results through our own predictive scenarios. So these are just some of the lists that are leveraged with the highest confidence rate. Next slide, Val.
Sure. Just as a note, asset quality for a bank really refers to sort of the degradation of the assets, the loans we have over time. So it's an important measure for a bank because you want to know which loans are going bad and when. And there's kind of a waterfall. So we start looking at loans that maybe past due, past the 89th day, past the 90th day, and then they might fall into a non-accrual status, et cetera. And there are several levels. So to actively project what these items are would take additional models and research on each individual line item by each division, which is pretty heavy. So we sort of relied on predictive planning to sort of get us through that process.
Yes. So essentially, when we ran with one of the models, well, this is an example, but we took each of the metrics that we have within asset qualities, and we pulled data from going all the way back to 2014 and just ran it across the model, and actually getting some of the results. One of the pitfalls that we experienced was that if some of the data points at the bottom level were very disparate, like they did not have any inputs, then the models would not be as high of a confidence rate. So in order to resolve that issues, we actually got the information going up to the line of business level and then reran the model. In that way, we were able to get a higher confidence rate and then assign the results to each of the divisions.
Oh yeah, that's a great point. So in other words, we originally went down to the base level, cost center level to project out, and then we found that the data set was spotty. So when you have several months of like no activity, it's going to really skew your model. So we decided we didn't need it at that base cost center level. So we went up a couple of levels to the divisional level, and then we improved our accuracy.
Right. To the next slide. Yeah, this was a simulation that we were using off one of our loan accounts just to forecast and get results. And we pulled the range back, going all the way back to 2013 when we have our historical actuals. And then we were able to actually get results about 3 years ahead just to use as a benchmark. So, doing some of our rolling forecast or, preparing our budgets for the future, this would be a great starting point for us to take, in front of our business partners. And then it would start the dialogue to, okay, well, here's what, our confidence rate, roughly around the 90% of where it would be. Are they aware of any other layers that they may adjust to? Is there any big deals that they that they could be adding to it? Would there be any information that we have in regards to, the economy that could, delay or expedite? And so this tool is very useful for us, as in such a way that it provides us with a great benchmark. Val, would you like to add anything to this?
Yeah, sure. So in addition to that, so we talked about the speed. This generates results, in seconds. You could load that and take a look very quickly. Your alternative to doing that is, of course, building your own models, and then that sort of intimates that you need some sort of statistical knowledge on your team, and your team might or might not have that. If it doesn't, typically you would go out to another vendor like Deloitte Touche, my old firm, and you can hire consultants to build models for you, but they're not going to really deviate from some of the models that you see here. I mean, so predictive planning uses 11 models and chooses the best fit. I assure you that some of the other modeling techniques that are out there will do the same thing, but if you use a third-party vendor, they will definitely charge you more. So please use predictive planning. It's inherent in the tool. It's easy to use. The more historical data you have, the better your results. And again, the key thing here is if you've identified savings, savings here because you can do this quickly, that benefits you. That gives you more time to play number one and look at the mission critical items. Okay, thanks, Johnson.
Yep.
All right, so we've talked about budgeting and forecasting, how we use it, and hopefully I've given you some different ideas of using the tool in a different way, especially when we are very big on predictive planning. But the other area that we use it for is management reporting. Now, for better or worse, we don't have an end-to-end ERP system. We have a general ledger, and to that we've sort of strapped on EPM. And EPM is kind of our management reporting tool, but it also does regulatory reporting as well. By that, I mean, for us, it's our segments. And this is really a success for us. Using alternative hierarchies, we've created reporting segments that were not easy to do within our own general ledger system. Now, since 2013, Western Alliance has actually reported on 11 different business segments. We tend to be an outlier. So we did a study several years ago looking at segment reporting in the 10Qs, and we were the outlier. We reported the most segments. Most banks, especially in our size category, report on anywhere from 2 to 5. So we were doing a lot of work that really wasn't benefiting us. So management approached FP&A a couple of years ago and asked, hey, let's try to collapse our business segments into like 2 or 3. Can you do that? Now, the current GL tool was not flexible enough for the accountants to do that on the fly. But since we have these alternative hierarchies, we easily put together simulations of what several likely segment reporting scenarios would look like. And we did 2, 3, 5. We were able to quickly put together something and present it to the board. And eventually we settled on 3. And again, for us, relatively painless to do. It's just taking cost centers in an existing hierarchy and putting them in a different configuration in an alternative hierarchy. So that was a very big win for us. And if you take a look at our recent 10Q, you'll only see 3 reporting segments. And if you go back last year, you'll see 11. So big win for us. You can use alternative hierarchies to look at your cost center views. And here we have different views for regions, product lines, even reporting managers as well. We can also do it for accounts. Here we have different products, different line item configurations. And what that means is that there's typically a standard set of financial statements, cash, et cetera, et cetera. But then we have different reporting hierarchies, which allow us to report different, to to combine different line items. So the SEC and various other regulatory agencies have a different way of looking at certain line items. And we can easily accomplish that through alternative hierarchies. The other way we use it, which is kind of interesting, and I'm assuming that most businesses do have this sort of thing, is that we have embedded businesses within our major divisions. So for us, for example, there's what we call the SBA 7A loan program. The SBA is the Small Business Association. 7A is a type of loan for a type of customer. It's embedded in the normal divisions in the big banks. But if we wanted to see how the SBA 7 loan program was doing as a standalone, we can do that because they have their own unique cost centers. So all we do with all our alternative hierarchies is that we just add these cost centers together. So we can take a look at the efficiency and the effectiveness of embedded businesses without that much work or effort. It's just an alternative view. It's just a report that we could run. So in addition to budgeting, forecasting, and the alternative hierarchies, our management reporting, and I've mentioned this before, EPM as a backbone uses Essbase, right? That multidimensional database cube. And that is, that's a pretty hefty tool. And what I'd like you to begin thinking about is thinking about, how the rest of your firm would benefit from using that tool. So kind of think outside of FP&A or accounting or finance, and what is the rest of the firm? How would they benefit from using this? interRel actually helped us set up an additional database cube that has 12 dimensions. So for a bank, we're very focused on what we call NIM, net interest margin. And here, this additional database that we use, Plan 3, it gives us granular insight into interest rates, FTP, which is funds transfer pricing, the maturities and the originations of our loan portfolios on a very granular basis. So very, very, very helpful to us. But, we went outside of our own box and said, okay, we've got these additional database cubes that we can use. We created a rates cube. It's a daily rates cube. So we load rates daily. So, all the standard interest rates that are out there, LIBOR, et cetera, we load in. And we made that available to corporate treasury. So it's just an automatic feed. It's a database that's populated every day, and treasury, everybody can use it. But the treasury didn't really have tools like that. So we sort of thought, okay, we can help them. So that was good. We've also created a GL only version of our database, which sort of excludes things that we do in terms of allocated expenses, funds transfer pricing, and taxes. And we've done that for the accounting group. And the key thing here is, again, you've got EPM. It's a great tool for FP&A, does the budgets and forecasts. But as a backbone, it uses Essbase, which can be used by a ton of other business partners out there. So, we would ask you to think about your firm in total using EPM, not just for financial planning and analysis. Finally, that leads us to M&A. Now, we're pretty unique, and I've talked to a lot of business partners across a lot of industries. We're pretty unique when it comes to thinking about M&A. And the typical problem or the hypothesis for M&A is this. You look at two companies, Company A and Company B. Company A is usually yourself, it's worth X. Company B is a potential target, and it's worth Y. And the hypothesis is, what would Company A plus Company B be worth? And in M&A speak, what we're saying is, okay, if we combine the two companies, are the earnings accretive to earnings per share? So would the combined company actually boost your earnings per share number? There are a number of different ways of looking at it. This is just one way that we've chosen that is successful to us. The other thing to think about is your financing and certain other considerations. So in other words, if you're thinking of acquiring a company, is it going to be 100% cash? Is it debt? Is it 100% stock? Is it some combination of that? Additionally, will there be cost savings? Is there goodwill? Will there be write-offs of loans? So there's some additional calculations that go on. So we would say, think of your financing and your additional considerations as company C. That frames M&A as an aggregation kind of problem. And what does that mean for EPM? Well, EPM aggregates really, really, really well. So we've created a database, and you can too, that contains your latest, our latest budget or forecast. That's company A. And here's a hint. If you create a unique database cube, you can use data push in EPM to populate that cube. It doesn't have to be at the detailed level that your source cube is at either. It can be at a very summarized level, which is what we do. Your potential acquisition, company B, can also get populated in that database. And here's a hint. It's easy if you use common financial statements. So if the financial statements of your potential target look like yours, and for a bank, they pretty much do, use that. We, in fact, use S&P Global Market Intelligence. It's a service that we ascribe to that allows us, public information, but it's in a more digestible form. So we can download detailed financial statements of any public entity that's out there. And the financial statements, for the most part, will look like ours as well. So company A, that's us. We've populated our unique database. Company B, we're going to download information, straight through the web, populate actuals, and then come up with some sort of forecast. Add that company A and B to company C, and company C is really just planning accounts that take into consideration multiple scenarios. What if we're using debt? What if we're using cash? What if we're using stock? Some combination. So you can have multiple M&A scenarios with how to acquire company B. And then, of course, there are additional considerations. Will there be cost savings? Will there be additional costs that you didn't think of? What happens to the write-off of bad loans? That has a balance sheet impact. What happens to goodwill? That's also another balance sheet impact, et cetera. So EPM, very powerful tool that just aggregates effortlessly. And we use it to look at potential M&A. And, we just acquired AmeriHome last week. So this seems to be working for us. So to sort of summarize, we use EPM in ways that I'm hoping that you're going to think about using as well. In terms of its core usage, budgeting, forecasting, we take a flexible approach, and we utilize predictive planning. The EPM tool allows us sort of degrees of freedom from moving away from sort of a one-size-fits-all approach or even process. And we can tailor our needs to each individual financial statement line item. Secondly, our use of alternative hierarchies within EPM just gives us a tremendous amount of flexibility for management reporting. And for us, that includes 10Qs and 10Ks that you normally wouldn't have in core GL systems. Third, not just EPM as a forecasting tool, but understand that it uses Essbase, Hyperion Essbase as a backbone. And that's a super powerful tool. And that is very valuable to your different business partners. Just have to think outside of FP&A. And then finally, since it's really, really, really good at aggregating, we just use it as a way of looking at potential M&A targets as well. With that, if we want to take questions now, I see we have a few minutes. If not, we can wait till later. But Robin?
Yes, any questions from the audience for Val and Johnson? If you have any questions, please ask them in the Q&A box at the bottom of your screen. Okay, well, it doesn't look like any questions have come in. So I want to thank Val and Johnson for your presentation. It was very interesting and informative. And thank you all for attending. Please stay. Oh, here comes a question. All right. What do you use to maintain your hierarchies and how often do you update them?
Okay, so we technically, we do not have the EDM tool. We are thinking of acquiring it. And then for EPM, we're actually on a version behind EPM Enterprise. We're actually on EPBCS. They branded it as EPM. So currently, we're manually keeping track of our hierarchies. So a little difficult. We believe once we switch to EPM Enterprise Edition, and especially when we upgrade to the EDM tool, that will allow us, that will just save us a ton of time. We also don't have a data governance team. We did, but our primary person sort of left and the team was sort of in disarray. So that sort of left us on our own to come up with our own solutions. So we are going to rely on the advanced EPM technology to help us solve that problem. Good question.
Great. Any other questions? All right. Well, thank you again, Val and Johnson, and thank you all for participating. I encourage you to stay tuned for our next session at the top of the hour, presented by Nationwide, entitled Head in the Clouds, Nationwide's Journey to Oracle Enterprise Planning and Budgeting Cloud. So thank you both and stay tuned for our next session.
Thanks, everyone.